What's going on, everyone? Today we are going to talk about how to buy your first home. To a first-time home buyer, home ownership is very exciting, but it can also be a little scary. I remember 8 years ago when I decided to purchase my first home, I had no clue where to start. So I went on Zillow to start to look for homes for sale, and I contacted an agent who was showing an ad right next to the property I was looking at. Working with that agent didn't turn out to be a good decision, and I almost lost on my dream home. Since then, I've purchased 3 primary residences one after another, and I also own a couple rental properties. As a full-time house flipper, I've purchased and sold over 2 dozen homes so far, and the home purchase process to me is like a piece of cake now. So I want to show you how to purchase your first home step by step so you can make well-informed decisions while finding your dream home. In this video, we're going to talk about how to choose the right lender and get pre-approved, how to find the right agent to work with, and how to find your dream home. After you've located your dream home, how to make an offer and do due diligence. Before you can start looking for homes, the first step is to get pre-approved. An important question you want to ask yourself is how much money you want to put as down payment. As a first-time home buyer, you have 3 main options. The first is you can get an FHA loan, which allows you to put down as little as 3.5% of the total purchase price. The second one is many lenders allow you to put down 10% of the purchase price, and you have to pay for a mortgage insurance every month. The third option is the most common, which is you put down 20% of the total purchase price, and you don't have to pay a mortgage insurance. If you don't have a lot of money saved up, an FHA loan might be a good option, but you want to work with a lender to make sure that you are qualified for an FHA loan. And also, the home you want to buy allows you to use an FHA loan because not all homes can be purchased with an FHA loan. If you have enough funds available, you might want to choose the 20% down option because it will save you money by not having to pay a mortgage insurance, and a higher down payment percentage will also allow you to get a better interest rate. Another important question to ask yourself is how much money are you comfortable to pay for the mortgage every month? Different lenders have their own guidelines to make sure that you don't exceed the debt-to-income ratio they allow. But as a first-time home buyer, it will be helpful for you to understand the financial responsibilities and your comfort level. I recommend to use the Zillow payment calculator to get an idea. If you are purchasing a home at $200,000 and you put down 20%, $40,000, with a 30-year fixed mortgage program, assuming you get an interest rate at 3%, the monthly mortgage payment, principal and interest would be $675. And your financial responsibilities also include property taxes and homeowner insurance, so the total monthly payment comes out to about $858. Once you have a good understanding of your financial situation and your affordability, it's time to choose a lender. There are 3 main types of lenders that you can choose from: the big banks, small community banks or credit unions, and mortgage brokers. Working with each of these types of lenders has its own pros and cons. For example, the big banks usually have the best interest rates, but they are also the most strict with their underwriting. If you have a stable job, a 2-year employment history, and a relatively low debt-to-income ratio, then you may want to work with a big bank to take advantage of the low interest rate. But you would want to work with a good mortgage salesperson at the bank who has a good understanding of their underwriting guidelines. Because sometimes the mortgage salesperson, if they don't understand their underwriting guidelines that well, they may tell you that they can do the loan, but only after extensive underwriting they find out that they cannot pre-approve you. It will be a huge waste of your time. Compared to the big banks, smaller community banks or credit unions are much more flexible with their underwriting, and they can turn around a loan much faster too, but their rates are not as competitive. So the trick is, you go to a big bank first, and based on your financial situation, they give you a quote, and you take the quote to a community bank and have them match the rate. If your financials are not that straightforward, for example, if you work part-time jobs, or if you are a business owner, or if your credit score is not that great, then you may want to consider working with a mortgage broker. Mortgage brokers usually have a variety of lenders that they work with, so they are a lot more accommodating. When I was purchasing my first rental property, my debt-to-income ratio was already maxed out by my primary residence, but I worked with a mortgage broker who was able to use the potential rent income from the new rental property to qualify me, even though I didn't have enough landlord experience yet. The downside of working with a mortgage broker is the interest rates are higher, and sometimes you have to pay an origination fee to pay the broker too. Based on your financial situation, you want to choose the type of lenders that you want to work with, and you want to get a few quotes. When you get the quotes from your lenders, you don't want to just compare the interest rates, because the borrowing costs include the interest, the points, also called the origination fees, and mortgage broker fees, and some other charges too. To compare all these quotes apples to apples, you want to use the APR, annual percentage rate. The APR is the best measure of the cost of borrowing money. It includes the interest rate, points, mortgage broker fees, and any other charges that you have to pay to get the loan. So the APR is usually higher than the interest rate. Most lenders provide the APR to you in their disclosures, even though they may not tell you what it is. Even if you didn't get it, you can ask them for it. Once you decide on the lender you want to work with, it's time to get a pre-approval letter. The lender will ask you for a lot of documents, including bank statements, tax returns. They will also run your credit report and verify your employment. It's a tedious process and it may take a few weeks, but it's important to do this exercise because it gives you a good idea of how much house you can afford. Once you know the exact amount you can afford, it really helps you to narrow down the search. The next step is to find an agent. When you purchase a home, your agent will be paid by the commission that's included in the purchase price, so the agent's ultimate goal is to earn a commission. But you want to find an agent who looks out for your best interest and won't push you to purchase a home that's not right for you. To find a good agent, the best way is to ask for referrals. If you have friends and family members who bought homes before, ask them who they used and if they like the agent. And you can also search for reviews of agent on Yelp, on Zillow, and on Google. I mentioned in the beginning that when I was purchasing my first home, I first went with an agent who was running an ad on Zillow, and it was not a great experience. You could tell if an agent is trying to make a quick sale because when she was showing me properties, she only mentioned the good things about those houses and she tried to brush away my concerns. She also seemed super busy and was not responsive. When I worked with her in-house mortgage broker, it took them forever to get me a pre-approval letter, and I almost missed out on my dream home. Luckily, I didn't sign an agreement regarding her representation, and I started to look for a backup. So a great agent was referred to me by a friend. This new agent is super responsive, and she was able to get me a pre-approval letter within 2 days. And whenever we went to see a house, she would tell me all the things that she didn't like about the houses without me even asking. So these are the important traits that you should be looking for in your agent. The third step is to find the home. Usually your agent will help you set up a search on MLS, so you get notified every time a home that meets your search criteria comes on the market. You can also browse yourself on Redfin or Zillow. Redfin connects with MLS better than Zillow, so the result is more reliable there. On your search for a dream home, the most important factor is location because location determines the value of a house. You want to choose a place that is safe and convenient. Ideally, it will be close to your workplace so you don't have to deal with long commute. If a home is close to job opportunities and transportation, the value is usually higher. The school district can also affect the value of a home by a lot. Even if you don't have kids yet, you may still want to invest in a property that's in a good school district because those houses usually hold their value better even in a recession. You also want to avoid uncommon features that can negatively impact the value of the home, like homes with a flat roof, without a garage, on a busy street, or close to commercial buildings. When you look at homes, you want to pay attention to the big ticket items like the foundation and the roof. If a house has foundation issues, it can be very costly to repair, sometimes even up to $50,000 to $100,000. Even as a house flipper, I try to avoid homes that have foundation issues. That being said, small cracks on the foundation are very common and you don't have to be alerted. But if you walk into a house and notice that the floors are slopey, then you either stay away or at least get a foundation inspection. The roof is another big ticket item and it can cost $15,000 to $20,000 to replace. So if the home you like has these big ticket issues, then you would want to investigate further by doing inspections and budget for the repair costs. To find a dream home for you, you want to make sure that it meets as many of your criteria as possible. You probably already have a long list of items, but to give you more ideas, the things that were on my list were open concept, big kitchen island, big master bathroom, and walk-in closet. Many people have asked me, should I buy a fixer-upper and do a remodel myself, or should I buy a home that's already remodeled? Well, it really depends on how much money you have to spend and how much you are going to enjoy managing a remodel project. Many people think that they can save a lot of money by purchasing a fixer-upper and do the remodel themselves because they wouldn't have to pay the premium for a remodeled home. It has some truth to it, but when you purchase a home, you can use a mortgage to finance 80% of the purchase price. But when you remodel a house, you have to use your own funds to cover the entire remodel cost without any additional financing. To give you an example, if the cost of a fixer-upper is $1 million and the cost of a remodeled home is $1.2 million, then to purchase the fixer-upper, you have to put down 20%, that's $200,000, and to purchase a remodeled home, you put down 20%, that's $240,000. But when you remodel the fixer-upper, you have to use your own funds to cover the remodel cost. Let's say it's $100,000, so your total out-of-the-pocket cost would be $300,000 versus the $240,000 that you put down on a remodeled home. When you remodel a home, you also have to deal with contractors, and that's not always a pleasant experience. I've had a nightmare situation dealing with contractors on my first flip. You can see it from this video. After you've found your dream home, the next step is to make an offer. Making an offer on a home is an art because you wouldn't want to offer too much, and you also don't want to offer too little that will cause you to miss out on your dream home. To make an offer that's just right, you want to rely on the comparable sales in the area. Comparable sales are the homes that are in the immediate neighborhood, usually within a quarter or half a mile radius, that have very similar features with the subject home. To get information on comparable sales, you can ask your agent to pull a CMA competitive market analysis report for you. On the report, you want to look at the homes that are similar in square footage, have same number of bedroom and bathrooms, and similar lot size, and in the same general condition. In an offer, the price is of course the most important thing, but you also don't want to ignore the contingencies that you can use. There's property contingency, which allows you as a buyer to inspect the property thoroughly after your offer is accepted. That's the time for you to order inspections, check out the foundation and the roof, and decide whether you like the neighborhood or not. Within the property contingency, you can back out of the contract anytime without any consequences. There's also appraisal contingency, which gives your lender some time to get an appraiser out to the property and give you an appraised value. If the appraised value is less than the purchase price, then you can also back out. There's also the loan contingency, which lets you back out if your lender fails to perform. You want to use these contingencies to protect your best interest and make sure that you are not held accountable if any of these conditions is not met. That being said, if the housing market in your area is very hot, then you may want to not use any of these contingencies to make your offer more competitive and increase the chance of it getting accepted. For example, in the Bay Area, where the housing demand is much larger than the supply, the housing market has been hot for many years, and it's very common for buyers to make offers without any contingencies. And when I review offers on my completed flips for sale, a lot of times I don't even look at offers that have contingencies. Once your offer is accepted, the next step is to do due diligence. The due diligence should happen during the contingency period, but if you are making an offer without any contingencies, you should do the due diligence before you make an offer. Because the point of due diligence is to make sure that you don't have any second thought while you can still back out. This is the time for you to drive around the neighborhood, especially when it's dark, to see if there's any suspicious activity or anything else that may make you feel unsafe. This is also the time to get a home inspection and inspections on any big ticket items if they are not provided by the seller. During the contingency period, if you find out defects of the home that were not disclosed by the seller originally, you can even go back to renegotiate on the price. If you don't find anything wrong during due diligence, the last and final step would be to close on the loan. During this time, the lender may ask you for additional documents and updated paperwork, and the process may take longer than expected, so it's important to continue following up with them regularly to make sure that everything is on track. Once the loan is closed, you will be the proud owner of your dream home. That's one of the best feelings in the world. I hope this episode was helpful, and if you have more questions regarding the home purchase process, comment below. If you enjoyed the episode, smash the like button below and don't forget to subscribe. Thank you so much for watching. See you next time.